Basics of option trading. This is what we are going to see today in Market Secrets option trading series. So let's get started. Basics of option trading. So when it comes to option trading, there are two options. You can either be a buyer or you can be a seller. If you are an option buyer, there is a good news. Your risk will always be low and your reward will always be high. What does it mean? Let's see it in detail. So this is a typical option chain that we get from NSE. If you look at here, this 75 represent price of 12,200 call option. So if you are a trader and if you think the Nifty is going to go up by 100 points and if you want to buy it, you will need at least 1 to 1.5 lakh capital in your trading account. Only then you will be able to buy Nifty. So you will be exposing the entire 1 lakh or 1.5 lakh rupees of your capital as risk when you buy that particular future contract for Nifty. But when it comes to option trading, the capital required will be very low. So the entire amount that is exposed, that is given as a risk, is very low when you compare it with futures. That is why option buying is always called as low risk high reward game. So consider Nifty is currently trading at 12,226 and as you all know, lot size of Nifty is currently 75. So if you want to buy this 12,200 call option which is trading at 75 rupees, you will need a capital of 5,625 rupees only. So compare it with 1 or 1.5 lakhs of capital required for taking up futures. This is very minimum. It is almost just 5% of the capital when you compare it with the futures. So your total risk for this trade is only 5,600 rupees. That is why it is called low risk game. But what do you mean by high reward? Let's assume Nifty goes up by 100 points. So this 75 rupees will approximately become 175 rupees. So when you sell this call option, you'll be getting around 13,125 rupees. So if you look at the payoff, your capital is 5,625 rupees and your returns is 13,125 minus 5,625, which is 7,500 rupees. So you have more than doubled your capital here. That is why option buying is always a high reward game. So you can easily make 2x, 3x or even 4x of your capital with option buying. So here the risk is low. The entire amount that is exposed as risk is very low when you compare it with futures, and the return generated is in multiples of your capital. So it is always a high reward game. So let's go back. So option buying is always a low risk, high reward game. What about option selling? So when it comes to an option seller, odds are his friend. So if you are an option seller, odds of winning is extremely high. It is almost around 90%. So even though the risk is very high for option seller, the odds of winning is extremely high. He wins around 90% of time. So if you look at this particular table, most of these option contracts will go to zero at the end of expiry. So the sellers will be reaping maximum benefits. He will win 90% of this. So to put it in simple, option trading is nothing but a game between risk and odds. So if you are an option buyer, your risk will be low, but your odds will also be low. But if you are an option seller, your risk will be high, but odds of winning will be high as well. So it's a trade-off between risk and odds. So you can decide which way you want to go. So whether you want to be a buyer, whether you want to be a seller, or if you want to do both. It's totally up to you. But one thing to add here is option selling requires huge amount of capital. The capital required for selling one lot of option will be same as the capital required for buying or selling one futures contract. So moving on, if you are an option trader, you need to keep a track of high volatility events that is happening. In general, high volatility events are something like state elections, central government elections, RBI meetings and RBI announcements, and even the board meeting and results of some specific companies can create high volatility in the market. So you have to be aware of such days in the market. For example, during the election period, the volatility will keep on increasing for some 6 or 7 days. In those days, you'll be seeing both call option and put option prices shoot up. Even though the stock or Nifty is going up, even the put option, which was supposed to go down, will go up because of the increased volatility. So you should keep a track of such events so that when that particular event takes place again, you can easily reap the benefits. For example, if there is a high volatility event that is planned in the near future, you can actually buy both call option and put option, and if the volatility shoots up, the price of both the options will shoot up, and then you can exit both the trades. And at the peak of the volatility, you can sell both call and put options, and you can let the price to come down immediately after that particular event is over, and you could have reaped the benefits of this particular high volatility. So you need to keep a track of India VIX, that is the volatility index that is available in India. So you can add it to your market watch and keep a close track of India VIX. So the general guidelines is, if you think the volatility is going to shoot up, then consider buying options. And if you think volatility is going to go down, consider selling options. As simple as that. So moving on, the next important thing that you need to be beware of is theta or time value. The start of the month is always good for option buying because theta will slowly decrease. The time value of the option won't have much impact. So if you can correctly predict the direction of the stock or index, you can buy an option at the beginning of the month because theta is not your enemy. It is not having big impact to the option price. But in the second half of the month, especially in the last 2 weeks or in the last week of the month, you need to be very careful when it comes to option buying, because the theta value will have a big impact on the option price. So even though the stock is moving in your favor, if it is going to move really slowly, this will kill your trade. If you have bought a call option contract in the last week of the month, and if the price is moving in your favor, but if it is moving really slowly, then the theta will kill your trade. Even though price is moving in your favor, the option value will not increase in the same proportion. So even though price is moving in your favor, option contract will same at the same price, or it will even go down, so you may end up in loss. So you need to be very, very careful if you are going to buy option at the end of the month. If you are an option trader, focus on buying options at the beginning of the month, and you should focus on selling options at the end of the month or the last week or last 2 weeks of the month. So understand theta and take advantage of it. Just like volatility, you can even take advantage of theta. So moving on, be very careful when you are trading naked calls and naked puts. This is especially true on the sell side. If you are going to sell naked calls and naked puts, you are exposing yourself to an unlimited risk for a limited profit. If you are a naked call or naked put seller, the entire premium that you get during option selling will be your maximum profit, but your risk will be unlimited. It can even run to crores. So just be very, very careful if you are selling naked calls and naked puts. It exposes you to unlimited risk. So never ever do it. If you are an option seller, you should hedge it. No buts, no excuses. If you are an option seller, you should be very, very professional. You should always hedge. No excuses. One bad trade will kill your trading career. So be very, very careful when it comes to naked call and naked put selling. If you are an option seller, you should always maintain a 10% buffer from MaxPain before selling any contract. So MaxPain, we have already explained this in a different video. So click on the top right corner of this video to open the video on MaxPain. So once you have the MaxPain value, you can consider selling option contracts that is 10% away from the MaxPain. So this is one other aspect that will help you when it comes to option selling. And lastly, if you are an option seller, try writing more call options when you compare it with put options, because fear spreads much faster when you compare it with greed. So if there is one big news, it can give you a very big fall. For example, the Lehman Brothers collapse triggered the stock market crash of 2008. So one single event can pull down the market because fear spreads much faster than greed. So if you are an option seller, you should be writing more call options and less put options. That is one another aspect that you need to remember. So these are the basics of option trading that we wanted to cover today. If you have any queries, let us know in the comment section of this video. Also hit the like button if you have liked this video and subscribe to our YouTube channel so that you won't miss any future videos or live sessions. Thanks again for watching. Have a great day. Goodbye.